Cashflow Diary Podcast, episode 319.
Welcome to yet another exciting episode of the Cashflow Diary Podcast, the podcast that teaches you insider tips, tactics, and strategies for creating leverage streams of cash flow into your life. Learn from top-performing entrepreneurs, business owners, investors, and thought leaders from across the globe as they share their secrets to success. Like what you learn on this and other Cashflow Diary podcast episodes? Go to learninvestingnow.com and sign up to receive powerful tips and information that will help you succeed as an entrepreneur and investor. Now, here's your host, investor, entrepreneur, business owner, educator, speaker, author, and master facilitator of Robert Kiyosaki's cash flow game, Jay Massey.
All right, ladies and gentlemen, welcome to another episode of the Cashflow Diary Podcast. I'm your host, Jay Massey, and I'm glad that you're here today, and here's why. Oftentimes, I am asked, Jay, where on earth can I find investors? Where on earth can I find capital? How on earth did you get started? Well, today, ladies and gentlemen, what we are going to do is I'm going to, quote unquote, reveal the secret of where I found my first, $5 million of private capital. That's right. I said my first 5 million, meaning there's been more since then, but I think there's opportunity still for you there today. Not only am I going to reveal that secret, but I also have with me today a person who you need to know because he has been the man, the myth, the legend, and has made a lot of what I talk to you about actually happen. We're going to be talking to one of the most pivotal members of your team, and in this case, my team, an attorney. You're like, oh no, not an attorney. Some of you probably just said, I'm not listening to the rest of this, but I'm telling you, listen to this because it will help you to make some money. I have with me today none other than Mat Sorensen. He's a partner with KKOS and most importantly, one of the leading authorities on SDIRAs. Now right there, you're like, what's that, Jay? Self-directed retirement plans. We're going to talk about it today because it is a great source of capital. He's written a book. He speaks on it all the time. And now, if you are wise, you're going to stop running on the treadmill. You're going to stop washing the dishes. You're going to go out there, grab a notepad and some pen or paper, or maybe you have an Apple Pencil on your iPad, whatever. You're going to go and take some notes as we uncover all the secrets you need to know and show you how it is absolutely possible for you to go out there and find the money that you need and get your deals done. Help me welcome none other than Mat Sorensen. Mat, you there?
I am here, Jay. Thanks so much for having me. You know, there is $25 trillion in retirement accounts.
25 trillion. How many zeros is that?
Yeah, that's a lot of money. And I always tell people this is the most investable section of cash in the United States. I speak throughout the country on this,
section. And I've never heard you say that phrase before. Most investable section of cash. Okay, that's interesting. Yeah. I like it.
So, I mean, if you're talking to someone, let's say, as you position the topic at the beginning, let's say you're trying to raise money for a real estate deal or a business, whatever it is, and you're talking to people to say, do you have cash you can invest in my business? It's more likely they're going to have cash to invest in a retirement account than they have it in their savings account or in some personal investment account. It's just where Americans have ended up saving a lot of their money. And so this huge section of $25 trillion of cash to invest has been sitting there, and a lot of smart people like you have figured out, oh my gosh, these can be invested in my real estate deals. And that's been my niche area for the last 10 years is teaching people, not only like yourself, how can you raise this money from others, but then also the people that have the money. Right. They don't want to buy the crap they have in their retirement account. They don't want mutual funds anymore. You know, if they have a retirement account and it owns mutual funds and they don't really want that stuff, they just buy it because they kind of have to. They don't really have any choices. They don't, at least they don't think they do. So that's what I want to talk about. Broaden your mind here. If you want to raise money for a real estate deal, this is very important information because there's $25 trillion out there. And if you got money in a retirement account and you're like, why am I buying mutual funds? I don't even understand the dang things. I'd rather invest in a real estate deal. Yeah, let's talk about you too, because now you can really take control of your retirement account and get some better returns.
Absolutely, absolutely. And we're going to unpack all of that and more. Now, before we get too far ahead of myself, I want to ask you, Matt, because this is the first time you've been here. I've got to ask you the same question I tend to ask everybody else the first time that they're here. Are you ready?
I'm ready.
Okay. So I tend to look at today's entrepreneurs a lot like yesterday's superheroes. And I think entrepreneurs and superheroes have a ton of things in common. For example, occasionally we get dressed up and we put on what we call capes and you call suits. We go out there and use our special abilities to improve the quality of life of our customers and clients, et cetera, et cetera, et cetera. Also like superheroes, though, before like Spider-Man was, Spider-Man, he was just kind of Peter Parker doing his own thing. So my question to you is, before the book, before the national speaking, before understanding IRAs and practicing law the way that you do, we want to know your origin story. So before you were the superhero entrepreneur you are today, who is Mat Sorensen?
God, good question. I just loved watching Law and Order as a kid. Always wanted to be a lawyer. Thought it would be the coolest thing.
You're kidding. Are you kidding?
I really did. Yeah.
Oh my God.
I loved the law. I got married early in life and I was like, I got to get my crap together. Started having kids early in life. And so like, geez, I got to go to college. I got to get a law degree. I just committed to do it. So, but then I got out of law school and I was a prosecutor for a while. So I prosecuted felony criminal cases. I did the real Law and Order thing. I went to court every day. Yeah. I did this for like a year. But there's a secret. There's a dirty secret in that world. You make no money. It's like I made more money as an undergraduate, like as a sophomore in college, than I did as a prosecutor after becoming a lawyer, going to law school, passing the bar, getting $100,000 in debt. Wow. So I loved that job. It was super fun, cool. Like you're going to court every day, you're having trials, you're talking to judges, you got criminal defendants, you're plea bargaining. It was cool. I loved it.
Wow.
But I was going broke. So I decided, all right, I got to get into private practice. I always had a good business sense. I ended up working with Mark Kohler. Many of you guys may know. We ended up becoming partners about a year and a half after we started working together. This is back in 2006. And we've always just had an entrepreneurial law firm. Our clients are small business owners, entrepreneurs, real estate investors. We really kind of figured out how to be a affordable and effective lawyer for their specific situations. And what happened is, I started investing in real estate myself. I saw all my clients that were building long-term wealth, and they'd come in their late 40s, and I'm maybe doing their estate plan or something. And it's like, man, they have all these rentals and all this equity, and like they just kind of had normal jobs, but they just built up a little real estate portfolio slowly and surely. And it created long-term wealth. So I've kind of been going down that path myself in real estate in terms of my own investments. But with the IRA topic, what happened was about 10 years ago, we had a lot of clients, 2006, making a lot of money in real estate. And they were complaining to us, we don't like paying taxes. We're making too much money. How do we pay less taxes? And there'd been this strategy out there of, use your retirement account to buy your real estate and build up the wealth in your retirement account. Because if I buy a property for $100,000 and I sell it for $150,000 personally, I got to pay tax on the $50,000 gain, right? But if my retirement account buys a property for $100,000 and I sell it for $150,000, that gain goes back into my retirement account. I can go buy more property, but I don't pay any tax on it. It just grows tax deferred for traditional accounts or tax free if it's Roth. So it's one of the best areas to build wealth is a retirement account. We've always just thought you got to buy stock. We've always been able to buy real estate with retirement accounts. And so these set of clients were like really motivating us to say, help us figure this out. And that's, 10 years ago. And now we've really become experts in that subject, and particularly myself in helping clients who want to build long-term wealth in real estate and in other investments, use retirement accounts effectively because they are the most tax-efficient ways to truly build long-term wealth.
Got it, 100%. And indeed, at the end of the day, it was very, very interesting when I learned this, because I was a financial planner at the time when I learned that was, I'm like, what? So here's what I'm going to do. I'm going to play the devil's advocate role for many of the people who might be listening right now and not even believing what you just said, or not even completely understanding it. So I'm going to ask what I believe to be some of the more common questions that a lot of people are going to have, so that you can tell us, look, what's really going on and what's really possible. So let's, because you, by the way, I think it's really funny that you are actually a lawyer in real life, and you don't just play one on TV, or you can actually say, I saw this on TV, and then you did. Anyway, I just think that's really, really funny, to say the least. But at the same time, when we talk about, I see it on TV, how come what you're saying, if this has been possible, how long has it been possible, and how come we haven't heard about it?
Yeah. Okay. So self-directed retirement accounts, what I'm talking about here is basically you have a retirement account, whether it's an IRA or 401k, it could be Roth, traditional, doesn't matter. And I'm talking, you're buying real estate, like deeded real estate, or you're investing in an LLC and you own a piece of an LLC that owns like real estate. I'm not talking about buying a real estate investment trust or some real estate mutual fund. I'm talking about your retirement account really owns this thing. Or it could even be lending on real estate. It owns a trust deed on real estate.
Right.
But you've always been able to do that. The reason you've never known that, and why a lot of people are like, why have I never heard this? Even like I have CPAs and lawyers. I do professional certification training in the retirement plan industry. I do continuing education classes for lawyers, accountants, financial advisors. Half of the room is like, we've never even heard of this. And like our job is to talk to people about their investments. But the reason you never heard of it is very simple. The typical custodians of retirement accounts, Fidelity, Merrill Lynch, Charles Schwab, your local bank, they're financial services institutions. They sell financial products. When you want to invest in something, they got a menu. It has financial products, mutual funds, stocks, bonds. They don't want to put real estate on the menu. They don't make money when you buy real estate. They don't get commissions on it. It's an administrative nightmare for them. They don't have systems for it. So, and they don't need to. They just say, well, you're here, buy the stocks, bonds, and mutual funds. That's easy for us, and we make money when you buy it.
Whoa. So hold on, Matt. Now, someone just said, and I know it, there's like, hold on, you're saying that they've limited my choices?
Yeah, that is correct. So it's an institutional thing. It's Merrill Lynch's policy that you can't buy real estate, or it's Fidelity's policy. It's not a legal issue. You've always been able to legally buy real estate with a retirement account. The question is, who has your retirement account? Does your financial advisor, who gets commissions on what you buy? Does your financial institution, your bank, your brokerage firm, who again makes money when you buy financial products? If they are custodian of your retirement account, they're never going to tell you can buy real estate. And so the trick is moving your custodian to say, all right, Fidelity, I want to move my IRA over to a self-directed IRA custodian because they'll let me buy real estate. And so it's basically like firing Fidelity to hire a self-directed custodian, which is kind of like firing Charles Schwab to invest with Merrill Lynch. You're just changing who handles the account. It's not changing the type of account or anything. It's just changing who has custody of the account and is your custodian for your retirement account. And they then put restrictions on it. But if you're with a self-directed custodian, they're going to say, great, go buy real estate, knock yourself out. And they'll let you buy real estate or invest in an LLC that buys real estate, like I said, or trust deed lending. And so that's the process. That's what self-directed is. It's a little sad that people don't know about it. And it's not for everybody either. It's not like everybody should self-direct. But, I'll speak to a group of real estate investors and I'll be in a room and I'll say, how many of you know a good mutual fund to invest in right now? Not one person will raise their hand. And I'll say, how many of you know a good real estate deal? About like half the room raises their hand. And I say, how many of you own mutual funds in your retirement account? The hands all go back. How many of you own real estate in your retirement account? Their hands don't go up. They're like, what are you guys doing? Why aren't you investing in what you know? You're just buying garbage that the financial institutions and Wall Street have sold you, and you don't even want it, or you didn't even. So let's help you invest in what you know, and where you can have a competitive advantage.
Absolutely. Now, because there's a couple of things that you said, and I just want to make sure everybody stays on this train with us. Before we understand what a custodian is and their function and what they do, there's something that you said that I've heard a lot, and I would love for you to explain, because oftentimes when someone first hears about this, the first thing they do is they're going to run straight over to their HR department and say, hey, is our plan self-directed? And oftentimes the HR director says, yes. Can you please explain the confusion between what the HR person might be thinking versus what you are specifically talking about? Because I've learned that not all self-directed is the same.
Yeah, good question. So a lot of places will say, whether it's a 401k or even like a TD Ameritrade IRA, they'll say, yeah, our plan is you can self-direct it if you want. And what they mean by that is we'll let you have a brokerage window option, is what they call it, and you can pick what stocks your retirement account can buy. That's what they call self-directed. So instead of having to buy mutual funds that are just a package of stocks, they say, we'll let you pick which stocks you want to buy instead. And that's their version of self-directed. So that's to me not self-directed, really. I mean, you're getting certainly more options than like 10 mutual funds, but you're not able to get off the typical financial product menu of stocks, bonds, and mutual funds. So true self-directed would be, all right, I can really buy actual real estate. My IRA is going to own property directly, or it's going to own a piece of an LLC that owns property directly. That's true self-directed.
So, okay. So then in this particular case, the difference that I heard is that one will say menu. One restaurant only has chicken on the menu. The other one has chicken, steak, as well as shrimp. That's really what I'm hearing, because you're saying
essentially
we can have more diversification amongst asset classes, because even though it's quote unquote self-directed, what we have access to is all paper assets at the end of the day. Unless we do the true self-direction you're talking about, then we can go with a real property or a business. And can you still do the stock thing or no?
Sure. Yeah. I mean, you pick how much you want to buy with stocks, and you can leave that with a just brokerage type IRA or 401k, and then decide what portion you want to piece out to do direct real estate, or an LLC where you, as you say, have real ownership of property or real ownership in a business as opposed to mere paper assets.
Got it. Now, since we brought up this, we'll say custodian, we're going to call them restaurants for the moment. And I like Italian food a ton. Not everybody likes Italian food, and it's unfortunate for them. But if I'm at a restaurant and I only like Italian food, and that's what I want, how do I make sure I find a good Italian food restaurant? Also known as, how do I find a good custodian?
Yeah, that's a good question. There's probably 30 different companies out there that would be considered.
Hold on. How many?
30, approximately.
30. But yet, we don't know most of them.
Right, yeah.
At all.
Probably never. Yeah, unless you've looked into this before, you've never heard of them. They're not advertising on the Super Bowl, or, these are smaller companies. This is more of a niche area for sure. So, but these companies, like I said, there's about 30 of them. They would be self-directed IRA custodians. Really, for me, I work with a lot of them in the industry. There's really a few things to look at when you're looking at them. First, I would go to RITA, which is RITA, Retirement Industry Trust Association. If you just Google RITA or Retirement Industry Trust Association, they have a membership list. And RITA is the National Association in the self-directed IRA industry. They have a membership list and resources on choosing a custodian, which I would go there because it'll give you a lot of different options. But first thing, obviously, check fees. There's a wide variation of fees. There's some self-directed IRA custodians that will charge you over $1,000 a year for an account. There's some that'll charge you $250 a year. Most of the ones that we work with our clients are going to be in the approximately about $300, maybe $350 a year range for a self-directed retirement account. But again, there's some out there that are going to be over $1,000. So if you start with one of those, don't get discouraged. There's other fee structures out there that aren't so high.
Okay. Okay, hold on. Is that a flat fee? Is that what you're referring to? Is that a percentage of the assets? How are you coming up with those fees and those numbers?
Some of them have a flat fee. Some have a percent of your assets. Again, since there's 30 out there, there's frankly 30 different variations of how these calculate. But
of course.
But for the most part, flat fee is what you'll find. You may have some add-on transactional fees to do stuff every once in a while, but you'll typically find for most of our clients they're going to be in a flat fee scenario that's maybe $350 a year. If they need something rushed or they got to like process something, a new investment, they might have another $20 or $25 for that.
Got it. So the custodian then sounds like a very pivotal part of this whole transaction. Yes,
you have to have them. So just like when you have your retirement account, you have to have a Fidelity or a Merrill Lynch. You have to move your retirement plan money to a custodian to keep investing it. So if you have an IRA, for example, you always have to have a IRA custodian, and they have to qualify under the IRS rules as a custodian. And so those are banks, credit unions, and trust companies who qualify as IRA custodians. Most self-directed IRA custodians are trust companies. Mm-hmm. And that qualifies under the rules to be a custodian. So yeah, you have to use them. You roll your money over there. It's not, let's say you're at Fidelity with an IRA, you'd roll it from Fidelity to the self-directed IRA custodian. There's no taxes on it. And now you're with the self-directed IRA custodian. Let's say you moved over $200,000 and you're like, all right, now I want to invest it. Now you instruct them and say, all right, IRA custodian, I want to invest in XYZ LLC that's buying an apartment building, or I want to go loan money to my friend that's flipping a house on, 123 Green Street, or I want to go buy a rental property at, in what a city near you, whatever it is. And you will instruct them and say, this is what I want to buy. And then the IRA, they'll carry out your IRA to go do that. And it's all in your IRA's name. Your IRA buys the asset. Your IRA receives the income. Your IRA pays the expenses. You're not doing it. Your IRA is, and you're working with your custodian to make that happen.
Got it. Now you brought something up that I think is that we've got to talk about, because this is the other thing that I know a lot of people have heard, and you're going to have great insight into, because they after attending one of your events, or maybe even reading your wonderful book, or understanding that, hey, there's something more for them, because today somebody just learned that something more is for them. They're going to call their financial planner, they're going to call their HR department, and they're going to hear, oh, you're too young, you can't do that, you're going to have a 10% penalty, you're going to have this, taxes, that's illegal. All of those things are things that I know our clients have heard, because they tell me, and then I have to explain it. But can you address for everybody, why are they hearing that if what you're saying is true?
What's really important to understand is that sometimes what you don't know can, will, and always has hurt you. That's really what you might be discovering today, is some of the things that can, has, and always will hurt you. Well, the cool thing about this particular episode is, well, now you know. And not only do you know, you have some resources at your disposal to be able to take advantage of, to figure out, hey, maybe I can finally get that thing off the ground, whatever that thing is for you. Here's some more resources. One more for you. It's my book, Cashflow Diary, 10 Steps to Creating Wealth in Any Economy. Just go over to cashflowdiary.com/free book. Again, that's cashflowdiary.com/free book. Pick that up, put your name and email in, and I'll send it straight on over to you. It's got a lot of good ideas in there. In fact, you could probably use an IRA and fund most of them. Let's get back to Matt.
Okay, so the first thing you have to understand, the rollover rules. I'm going to try and explain it in basic terms.
Yes.
So
English, not lawyer, please. English, not lawyer.
Yeah, let me try. I'm usually paid by the hour, so I usually take a really long time to explain things.
Yes, you do.
So when we're talking about moving to a self-directed custodian, you're going to have to roll over or transfer funds to get there. Okay. Most people who are self-directing an IRA aren't starting an IRA from the very beginning and putting in $5,500 a year. most people who self-direct an IRA are rolling over money. So the easy one is if you already have an IRA, let's say you have an IRA with Fidelity or Merrill Lynch or your local bank, whatever. The IRAs can always roll over to other IRAs. That's easy. So if you got the Merrill Lynch IRA, whether it's a traditional IRA, a SEP IRA, a Roth IRA, it's easy. You can roll it over to a self-directed traditional IRA, a self-directed SEP IRA, or a self-directed Roth IRA. Those ones are the easy ones. You're always able to just transfer those, no tax consequence. The money goes right from Merrill Lynch to self-directed custodian, or whoever you have, Fidelity, whatever. Mm-hmm. The tricky one is for someone that has a 401k. Now, for 401ks, let's say you have a 401k with an employer. If it's someone you still work for and you have not reached retirement plan age of 59 and a half or older, generally your money is stuck in that company 401k because the company is going to say, well, you still work here. You have to participate in our company plan, and we lock your money down in our company plan until you leave or until you reach retirement plan age. Now, the nice thing is, if you have a 401k and you don't work for that company anymore, but you still have the 401k with them, you can always roll that over. So if it's a prior employer 401k, you can always roll that over to a self-directed IRA. Or let's say you're over 59 and a half, and even some plans it's 55 for retirement plan age, but let's say you're over 59 and a half, but you're still working for the company. You can also roll over that money because you've reached retirement plan age out of the 401k to the IRA. So your example of the one who gets stuck is the one that goes to HR. Let's say they're 45, they still work for the company, and they say, all right, I want to move my money because I want to self-direct it. How do I roll it over? And that's when they're going to get, well, you can't. You still work here. We make you leave your money in the plan as you still work here. You haven't reached retirement plan age either, so you're stuck there too. So sorry, you can't move it. You'll get a penalty if you want to take it out. That's the person who kind of gets bummed out, unfortunately. And those are the ones I can't help. You get stuck. Now, sorry. Everyone else, though, you can roll over and self-direct.
Okay, but so then, Matt, now put on your lawyer hat for a moment. Whose money is it really, then, if I can't touch it?
I know. It's your money.
Are you sure? Are you sure?
Yeah, but you don't have control of it. It doesn't really feel like yours, does it?
No, not at all. Not at all. Now, I know for most of the people listening right now that are, below retirement age and all these types of things, they're like, well, that leaves me out. Okay, Matt, you and I both know that there are some special options for some of them that they can go look at. So why don't you share with us some of the things that we've either been able to do or some of the things that you guys have found that also exist for those that are still listening. They haven't hung up, even though they're a little discouraged right now. What are some of those other things that you found that they're able to actually do?
Well, what do you mean? I missed that front part of what you said.
So
they're
specifically,
why?
I'm referring to the in-service distributions.
Oh, okay. Well, the in-service withdrawal is generally, if you reach retirement plan age of 55 or 59 and a half, you can always do that. You're still working at the company. That's one. Another option is you can take, if you still work for a company and have a 401k, you can take a loan out of half the balance, not to exceed $50,000. So you can get at least 50 grand out if you have 100,000 or more in your retirement account that you can go use personally for any other type of investments you want. It's outside of your retirement account and you pay the retirement account back, but it's, access to 50 grand, which is a decent amount to invest into a real estate deal.
Still better than zero.
Yeah. Still better than not, investing at all or leaving that 50 grand buying mutual funds. So, but the tricky part is, I've even had people leave, frankly. I've had some people quit their job literally because they wanted access, and they typically had a large account. And that was a motivating factor to leave, is so they could roll out their money. So I don't recommend that. That's a drastic measure. But if someone has the right opportunity and all their considerations are thought of, I can understand why someone would do it. But the one thing I did want to say too is, I think some people are listening and are like, well, I don't have any money in a retirement account.
Right.
So this doesn't really help me. So,
Well,
well,
that
wait
is
a
very,
second.
very true. Because when you guys were first explaining this to me, that's exact. I was like, listen, I was like, oh, that's great. That's great. That's great. This is wonderful. I didn't know this. This will help a lot of people, just not me.
Yeah, I know. But see, you caught the vision because I know you have a lot of people
Right.
you invest with that use retirement accounts.
Yes.
And that's what I want people to understand. And it's so funny how many people I've talked to that say, God, the first real estate deal I ended up funding with outside money was someone's retirement account. I had someone use a self-directed IRA. I've heard that so many times.
Right.
And that's what I want you to understand. Even if you don't have money yet in a retirement account, or you got like hardly anything, but you're out there doing real estate, man, you need to know these rules because accessing this money, there's 25 trillion out there. You are leaving a lot of opportunity on the table by not understanding these rules and how much money can be raised through self-directed retirement accounts.
You know what's funny when you say 25 trillion? It's a number we can't even relate to.
Right.
It's just like, how much is that? What could I buy with that? Everything? I mean, I don't know.
But think of the people you know. If you slice it up, it's like you probably have a friend that has 300,000 in their IRA somewhere. You got a uncle that's got 600,000 in it. You got a friend that's got 50 grand. If you think of the people you know and associate with, or the people you might ask to invest in something that you're doing, I guarantee you cut up all the little bits of retirement plan money, you're going to get to $1 million pretty dang fast.
Right.
And you're going to get to it faster with that retirement account, people's retirement accounts, than you are with what do you got in a savings account or a personal investment account you can invest with me. So when you understand these rules and you're really out there trying to get money, oh my gosh, this is so valuable to know. And that's why I really got into this subject. I mean, really, as a lawyer, I followed the money. I'm like, wait, there's how much money in retirement accounts? Okay, yeah, I need to focus my legal practice on this. And that's what I did for the last 10 years.
Indeed. Because as I said at the top, that's where I found the first $5 million or so dollars. I was just like, I didn't even understand that this was possible, but yet it was the very key to going out there and making things happen. What are some of the, I would say, most creative uses you've seen for people? So let's give them some ideas. Like what are some of the creative things you've seen people do? Either those who had a retirement plan account and were using their own retirement plan account, and those who didn't have a retirement plan account and was using someone else's.
Okay, let me give just a few examples. The first one is very basic, and I had one client come to me. She's an older lady. She had $150,000 in her IRA that she was buying mutual funds. She was at retirement plan age already. She was in her mid-60s. She was on Social Security, and she was needing supplemental income. Social Security wasn't cutting it. So she needed about $500 a month, and she was having to sell mutual funds out of her IRA to basically get $500 a month. And it was freaking her out. She knew this is not sustainable,
Right.
Like this retirement account is going to be gone. So she ended up buying simply a rental property in Phoenix, which is where I'm located. This is about 3 or 4 years ago. She took that 150 grand, bought a 3-bedroom, 2-bath rental property. It cash flowed nicely. Now what she does is she takes half of the cash flow that she gets on the property, distributes it to herself to supplement her income because she's in retirement. She's in her 60s. And her retirement account still owns this property that, by the way, has gone up in value in the last 4 years significantly. And she's not freaked out of having to sell off pieces, and she's not seeing it dwindle. So that was a really easy example of someone that's like, wait, how did this thing work? And I can just get cash off of my investments. And she was using it to supplement her income. That was a very easy, basic, simple, just a plain vanilla rental property.
Indeed. Hold on. Before we move on to the next example, I just want to make sure so that everyone gets this. So you're saying she took the 150, the whole purchase price for the property was 150 or less?
Correct.
Okay, so then not only, and then the cash flow that she received, therefore, was definitely after there. So there's no mortgage; it's just property management and those types of things. It was definitely more than the $500 she needs, but she only took the $500 she needed.
Exactly.
So there's money still going back into the account, is what I'm hearing.
Right.
And
Exactly.
You're telling me that the property value is more than the 150, even if it's quote unquote only 175. the account value has increased, and she's still receiving capital. And now she's not on what as a financial planner, I called them the spin down plan, because that's basically
right.
what
Yeah.
it was. You will be terminal velocity after 7 years. You're just toast.
Right. This will end.
Totally. But now she's got a more sustainable option with the same amount of money. And it wasn't an astronomical sum by any means. Right.
Yeah. And she didn't need a lot. I mean, she was, by herself at that point, and she did get some Social Security, but it wasn't enough. And she lived a modest life. And, but it was for someone like that, a retirement. And we're talking about really sacred funds for people. A lot of people have taken a lot of time to build this money up. And it's been a lot of blood, sweat, and tears to get it in there in the first place, even 150 grand.
Right.
And so, but there's so much satisfaction and security in her changing that strategy. But then I've got other ones. I mean, I have a client that has over $10 million in a Roth 401k.
Wow.
And he's a hard money lender. He basically loans to people. I mean, he used to get a lot better rates, but the market's got a little more competitive for private lenders. But I mean, he basically charges 2 points and maybe 12% interest about right now. He loans to people who are doing rehab work on flips. He usually loans that money out twice a year. And if you look at that and say, all right, I'm getting 12% and 2 points in 6-month term loans, that's 4 points and 24% every year. Yeah. If you add up someone doing that for 20 years, you can understand how he's got a $10 million plus Roth retirement account.
Yep. Yeah. And for those who might not understand the power of the word Roth, could you explain why that's really, really, really cool?
Yeah. So the one thing with retirement accounts I mentioned earlier is that, when you buy an asset, you buy something for 100 grand and you sell it for 150, in any type of a retirement account, a traditional account, a Roth, you don't pay any tax on the gain. But when you get to retirement plan age of 59 and a half and you start pulling money out of your retirement account, in a traditional retirement account, traditional IRA or a traditional 401k, when you pull money out at retirement, you pay tax on the amount you take out. So if I took out $10,000, for that year from my IRA, I'd have to take $10,000 on my personal tax return as income. And that's what happens with traditional retirement accounts. Now, when you put money in your traditional retirement account, the government gave you a tax deduction. So, they're trying to balance you back out on the back end by paying tax on the back end. And a lot of people use traditional accounts. But Roth is very cool because when money comes out on the back end, it's totally tax-free. So once I reach 59 and a half and I'm pulling money out, it's totally tax-free. So Roth accounts this is the only place left you can make money tax-free in the United States legally. Okay. This is legally. So if you want to make a great investment and get tax-free money back into your retirement, back to you, a Roth account is the only way left to do it. And there's people out there, there's a lot of people that have $1 million plus Roth retirement accounts that have just frankly invested in what they know. They find a competitive advantage. They're not buying stocks, bonds, and mutual funds. They go find a competitive advantage, find what they're good at, and they basically self-direct those accounts.
Yep, totally makes sense to me. Now, I know that there's more to this subject. I know that you've spent literally decades understanding this particular subject and explaining and talking about it and helping more. However, there's a number of people listening right now who, this could be the first time they've heard it. And they probably want more information. They probably want to know more about you and how the whole thing works. Could you do us a favor? Tell us what we could do to track you down and get more information. Just pretty much just tell us how to stalk you. That'd be great.
Yeah, I'd love it. So my website's the best resource, SDIRA Handbook for Self-Directed IRA, SDIRAhandbook.com. You can find my book on there, which is the Self-Directed IRA Handbook. This is the number one selling book in the self-directed IRA industry. I've sold 15,000 copies in 2 years. My book ranks above Susie Orman and Brian Tracy's books on retirement planning that are both in my category. Those are authors a lot of people have heard of, and I sell more books than they do. So the book's done really well. Almost all the companies in the self-directed IRA industry use my book, either with their customers or training with their employees. So it's really been a a big resource for people out there doing it, and it's got a lot of reviews. I got a 5-star review on Amazon. You can check it out. Everyone loves my book when they buy it. I've never had someone be like, "Oh, I didn't really like it." So at least they told me. But I have a free self-directed investor toolkit on my website. So if you go right to my homepage, you just put in your email and your name, and you get access to my free self-directed investor toolkit. I've got some webinars, some videos, some blog articles that are really geared to someone who's self-directing their retirement account or looking to do it for the first time, to make sure you understand the rules. Because as you said, there are some things you need to know when you start self-directing your retirement account. So I've kind of basically told people you need a rule book, really, because it's like playing a board game in a lot of ways. When you play a board game for the first time, if you just start moving pieces around and you don't read the rules, it's not very fun. You're going to get lost. You're probably going to screw it up. And if you're playing with other people, they're going to be like, what the heck is this guy doing? So you want the rule book so you kind of know what the heck you're doing when you go into a deal, when you call your custodian, when you got another real estate investor. You need to know what you're doing. And you also need to know it for yourself so you don't screw up your account. So that's what my book is. It's really the rule book. The self-directed toolkit is a great way to just grasp what you need to know to see, should I do this or not, or what are kind of the ground rules. So I've tried to make those resources available. Unfortunately, if you get out there and Google stuff about self-directed IRAs, you'll get a lot of people that don't know what they're talking about. There's some guru that is going to send you down the wrong path. They're trying probably to sell you something. So just seek out the education. I've tried to make it available and easy to digest information on my site and in my book.
Got it. Excellent. And thank you for that as well. So I've got one more, well, actually 2 more questions, but the next one is for our friends that might not be in the United States, but they, and so therefore is there anything like in their respective countries, do other countries have similar options, things like this, what we're talking about?
Yeah, there are. I've ran across it a little bit, but I know enough about self-directed IRAs in the U.S. that I'm not as good of an expert on anything else, so I don't really advise people on it. But there's, a lot of countries have retirement accounts, Canada, some European countries. So, but, I don't know a lot of the rules on them, frankly. But there are options for foreigners who could possibly self-direct into real estate. But I'm not skilled enough to tell you how to do that in those situations.
Got it. Totally understood. Just wanted to make sure everybody knew that there's at least a way or something to begin to ask questions, because you never know where the answers might lead them. So as we wrap up here, I got a question for you, because I think you're in a unique position. You enable lots of entrepreneurs to make things happen. I've lost track of how many entities you formed for me. And how many times we've had this IRA conversation. I literally don't even know. But so I've got a question for you. Let's pretend that someone listening right now, and maybe they're standing in front of the superhero outfit store. They think they're ready to be that entrepreneur. They want to go out there and make it happen. They're trying to choose what color cape they might even be wearing. But yet, Matt, in the back of their head, they still have that voice. And I know it's something you've dealt with. It happens every time we try to become more than our present place, or we want to affect change or become greater or do some good things out there. That voice comes up to remind us of what we haven't done and who we're not. And sometimes some people, they're actually related to that voice, and they have to deal with it on a consistent basis. So let's pretend that someone listening right now, that person is going to actually do what you suggest. And they're going to do it in the next 48 hours. What would you suggest that they do?
All right. I'm a practical person, and I face that thing myself, that stupid voice in the back of your head. And I think what people need to do is basically get educated in what you're trying to do. Test out your superpowers a little bit here, so to speak. I mean, a lot of people with self-directed retirement accounts, they didn't even know that they had, oh my gosh, I have $200,000 sitting here in this old 401k, or I got $300,000 in this IRA at my credit union that bought CDs and I'm getting nothing on. I didn't even know I had this sweet little secret weapon here that I could deploy into real estate and really improve my life and build long-term wealth. And so I want you to understand how you can use those tools. And the more you learn about how to use them, the more valuable they become to you and the more efficient you're going to be. So first, get educated. But when I say that, I also realize some people learn too much. They're out there trying to get too smart, and they're trying to outthink the whole damn thing. And meanwhile, there's 10 people already that have done something that they haven't.
Right.
Because they're still thinking about it, and they're still researching it, and they're reading their 10th book on it, And so you got to find the right balance, between that. You need to make sure you know what you need to know to make good decisions, but you also got to be able to make that jump and have some faith in yourself and what you're trying to accomplish, so that you're not just in analysis paralysis the rest of your life thinking about, oh my gosh, I can do this, but I don't know. You just have to make some judgment calls and have a little faith.
Absolutely well said. And I definitely want to say that I appreciate everything that you do. As I said, I feel you've enabled a number of entrepreneurs, including myself, obviously. And I want you to keep doing it because it's awesome what you help make possible and happen for people. So it's really, really cool. And I thank you for taking the time to invest your knowledge and wisdom here with us at the Cashflow Diary.
All right. Always a pleasure, Jay. Thank you.
All right, ladies and gentlemen, you know what time it is. It's time for you to move at the speed of instruction. What does that mean today? Well, today it means you're going over to SDIRA handbook.com. Why? Because you need the information, period. And then after you read the information, you're going to do what it says. Hey, give Matt a call. I bet you it'll begin to change your world just like it changed mine. Ladies and gentlemen, it's been fun talking to you today. I definitely look forward to talking to you soon. Until next time.